It's been a mixed week for high-growth stocks. Key ETFs were down on the week just past, while there has been a sharp pickup in the percentage of stocks within the Nasdaq 100 that are trading above the 5 and 20-day moving averages. Chip stocks have been among the best-performing growth stocks over the last week. For example, Qualcomm rallied by 6.15%, and Microchip Technology put on 4.9%. The broad-based Philadelphia Stock Exchange Semiconductor Index rallied by 2.5% and could now be moving out of its long-term downtrend. The rally in the semiconductor stocks comes as the Senate prepares to vote on a bill that would provide a wide-ranging subsidy to the sector that could run to as much as $52 billion, with another $200 billion being earmarked for R&D funding for the wider technology sector. Goldman Sachs' asset management arm cast an eye over the performance of growth stocks in the post-pandemic period this week. The money managers found that the fastest-growing or hyper-growth software stocks saw their valuation rise threefold between Q1 2020 and the market peak in November last year, with forward PE ratios for these stocks expanding from 10.3 times earnings to as high as 33.7 times. Unsurprisingly, it was this group of stocks that also saw the biggest sell-off. However, Goldman believes that the pendulum may now have swung too far the other way, with these hyper-growth stocks now trading on an average 12-month forward PE of just 8 times, whilst their high-growth peers are trading on an even lower forward PE ratio of just 5.7 times earnings. Goldman points out that software is now so embedded in consumer and company life that customer retention rates should hold up far better than during previous economic downturns, and areas such as network security software may not be affected at all. That said, the fund manager thinks that those stocks with exposure to large established companies will fare better than those selling their products to smaller or emerging businesses whose IT budgets could be vulnerable in times of economic hardship. Tesla will be one of the first high-growth stocks to report its earnings, which are due after the close on Wednesday. Analysts are looking for $1.76 per share. However, it's interesting to note that Tesla has surprised the upside by an average of 60% in the last 4 sets of quarterly earnings. Will it do so for the 5th time in a row, we wonder?